Thanks for joining David, Kevin, and myself for our educational video. I wish you were here a minute ago. I asked poor Kevin to move the tree. Of course he did, and it fell on top of him. Would have been great for the bloopers, but oh well, we'll get him next time. Today we're going to discuss the perception and reality of the stock market volatility. Quite often, David, Kevin, and myself will get a call. The market's moved up 1 or 2% based on some news that they've heard, and people are questioning like, why? What's going on? Why is the market moving so much? One thing I'm going to say before I get into that and pass it on to David and Kevin is remember that the media is trying to get you interested in watching their TV shows or reading their articles. So they need to make it interesting. They need to sensationalize that. So always keep that in mind. But David and Kevin are going to give you some insight as to what drives a long-term market investment growth. Thanks, and take care and enjoy the video.
One of the more fascinating things about the stock markets and individual stocks in particular is how much they can move on a day-to-day basis despite how little the underlying fundamentals of that company change. Every quarter companies release their quarterly earnings and tell investors, how profitable they were in the quarter or how much their profits may have decreased in a quarter, and also their forecasts for the next and upcoming quarters. And it's really those long-term earnings that drive the long-term performance of a stock. But intra-quarter, on a day-to-day basis, stock prices do fluctuate quite a bit based on headlines and based on perceived valuation. So, a company can release a new product and everyone gets really excited about it, and the valuation, the stock price, trades up because everyone buys that stock. And conversely, if a company does something that the public perceives as bad for the company, the share price can drop quite a bit. Even though maybe by the end of the quarter, the company's earnings haven't really changed that much. In fact, they may have gone up. So the breakdown of performance data for the S&P 500 index over the last 7 decades shows that over shorter time horizons, the valuations, the price to earnings of a company, are effectively the sole driver of returns, with optimism pushing valuations higher and generating gains, while pessimism or bad headlines may detract from valuations. However, as the duration of investment lengthens, as you can see from this chart, the shifts in perception about the future become less important, and what is more important is the fundamentals or the earnings of a company. And the added contribution from valuations only really comes when multiples are skewed towards extreme highs or lows.
Another factor in the short-term fluctuation of markets and investments is emotion. If we recall the GameStop saga of 2021, the extreme rise and then fall of that company's stock really had nothing to do with their business fundamentals, their profitability, or their future earnings potential. The bulk of investors who jumped into that stock read a headline or two, got a little antsy, and bought. And now we fast forward to just over 2 years later, and that company's stock value has returned to a level that much more accurately reflects its true value, thus proving that as we increase the amount of time, a business's fundamentals and their earnings really play a bigger role. In other words, a key to successful long-term investing is to avoid these knee-jerk reactions to short-term headlines and to instead buy and hold equities in quality companies that have sustained and above average growth at a reasonable value. Now, this isn't a new or revolutionary method to trying to build long-term wealth for yourself, but it is something that has a track record. It just requires us to be farsighted and to show discipline in not reacting to the ebbs and flows of short-term market fluctuations. It's important to remember that when we're looking at these certain headlines or situations, that what you're really looking at is a moment in time. And I know it sometimes doesn't feel like that when you're in that moment. It's easy for us to manifest these into much bigger scenarios, but truly they are moments. So if you take a look at the chart on your screen, this is a historical chart of the S&P 500. So let's pick out a moment in time. Who remembers how the market performed on June 11th of 2012? I know I don't. But When we did a little bit of research on that particular day, the market dropped 1.3%. Now, in that moment, I'm sure many investors felt a little panicked because it's easy to be sucked into the day-to-day happenings and headlines of the investment market and to feel pressured into making changes in response to this information, both when good and bad. But since that moment, however, the market has risen 214%. So in the grand scheme of things, that one moment really didn't mean anything to long-term market growth and the achievability of our goals.
Yeah, those are all great points, Kevin. And I think this year's a great example. Like, look at 2023. Coming into this year, pretty much no one that I talked to, whether it was a fund manager, an economist, clients, maybe even ourselves a little bit, nobody seemed all that optimistic. And yet the markets are up quite a bit this year, even though not a whole lot has changed. We still haven't gotten out of inflation's not back to 2%. There's still some rate hikes happening. And at the beginning of the year, it was quite compelling to just sell all your risk assets and buy a 5% GIC. Yet, had you done that with all of your money, you'd be behind the 8 ball now by quite a bit. So it's just all great points, Kevin, to remember that your investments are, the day-to-day happenings in the market matter for sure, but in the long run, they become less and less important. And just simply staying invested, owning good companies that are growing their earnings over time is truly what matters most. But as always, if you guys have any questions with your investments or your financial plan, please don't hesitate to reach out to myself, Kevin, or Harry.
Take care.